kind of...
Welcome to the Del Walmsley Radio Show. Del challenges the status quo, questions everything, and empowers you to return to your core beliefs to make your life better. If you're ready to hear the truth and get your roadmap to the lifestyle you really want, the next hour will change your life. And now, your host, self-made millionaire, national award-winning investor of the year, CEO and founder of Lifestyles Unlimited, Del Walmsley.
Welcome to the Del Walmsley Radio Show, where the hype ends and the help begins. I'm your host, Del Walmsley, and as always, we're working on your financial freedom. Today is Tell Del Tuesday, and with me today is John and Kathy Garcia out of San Antonio, Texas. Guys, welcome to the show.
Hi, Del. Thank you for having us.
Yeah, thank you for inviting us.
Why don't we start out by talking about what brought you to look into real estate investing? Take us back to that kind of point in your life where the two of you got together and had that conversation, we need to do something.
So John always knew and had talked about passive income well before we had joined Lifestyles, and just kept going, we got to have passive income. We've got to have multiple streams of income. And I said, okay, I hear you. And one day he came home and he said, I heard a guy on the radio, and I want you to listen to him. John always knew it was going to be real estate. He just knew it. And he convinced me to go to the free seminar, the Financial Freedom Seminar.
Yeah. And, I think in the beginning, I was, Kathy was a little hesitant. I mean, she's the analyzer. She's, listening and, well, how much is it going to cost, and what do we really have to do, and what's the financial commitment, the time commitment, and I was being the type A, like, let's just do it. It seems like it's the right thing for us. But she's the voice of reason on that. So we went to the 2-day, and we went to the what's the first one? It's just a couple of hours.
Introductory workshop? Yeah.
I was ready. I was like, let's do it. So we signed up, and Kathy's still like, okay, but hang on now. So she's like, we got to look at this with some, a little bit more. And I was gung ho. I was ready to jump in, and we went to the 2-day, and we were able to watch Dave Fisher. And of course, those who familiar with Dave Fisher, he makes it lively and it makes perfect sense. And I was ready to sign up. And then, of course, Kathy's like, okay, let's talk about it some more. And you need that voice of reason, right? I mean, you need that person to hold you back a little bit and say, let's just look at the numbers here and see what happened. And then we finally talked to Dave Fisher at the very end, and he's like, yeah, you're not ready. I was like, what? He says, you're not financially ready. You need to go ahead and you just need to get your finances in order. And he's like, you have the attitude, and obviously you have the you want to take action, but you're financially not ready. And so I was like, wow, okay. But that kind of leads you down to the integrity of the company when they just don't want your money. They're going, you know what, this is great, but you need to go ahead and become a little more financial. Get your finances in order. And so we had to take a step back and kind of slow down. And I had to start, I had to take that B person out of analyzing our finances and realizing that, maybe we aren't ready financially for this. I mean, it's, you want to join and you want to be successful, but you gotta be prepared for that. And so we took a back step and then realized that we were actually, I guess, more prepared than we thought.
Kathy, as an analytical person, doesn't that, to you, seem like the logical answer to get? If you're not ready, you're not ready?
If you're not ready, that was exactly right. I mean, that really did speak volumes to, hey, you guys really aren't financially ready. And as it turned out, and the day that we sat down and talked to David Fisher after that first 2-day, he was absolutely right. We weren't. But what we came home and found out, within the 2 months, we joined 2 months later, but what we came home and found out was we actually were. We just hadn't taken into account 2 different retirements that had already been, saved. We have money in the house. We had things that we could turn around and use as use to sell or to pull money out of retirements, pull money out of the house. And then we were ready to go. But the fact that he kind of made us take a step back and go, hold up, like, let's just wait a minute. So I'm very grateful that, one, John was very gung-ho and he knew this was the right way to do it. And I'm also grateful that he took a step back going, hold up, let me listen to Kathy for a minute. Let me just see what we really need to do. So I did appreciate the fact that that does happen. Clearly, we are now on the same page, and now we've kind of switched the roles a little bit. I'm more gung-ho.
Yeah. she's type A, and I'm more type B. Going, wait a second, hang on. Let's just look at the numbers on this real fast.
But we've learned. We have learned a lot.
So let's talk about the 2-day for a second. Let's go back to the 2-day. Kathy, what was your aha moments in the 2-day? I'm curious about the analytical point of view. What?
So I will be flat out honest with you. We sat in the back row, and we left early the first day. I'm like, are we sure we want to do this? Went back the second day, and I think there was a question that David Fisher asked people in the room, and he said, how many of you already have real estate? Because this was something I didn't want to be a landlord. I didn't understand any of this. This was just not in my, wheelhouse. When the majority of people in the class, and they were not all Lifestyles members, but when the majority of the people in that 2-day raised their hands, it was like, John is really right. This is really the way to do this. So I think that was one of my aha moments. And, of course, having some of the guests go up and speak, having Steve Zusterman go up and speak, who is always inspirational, that was another one of my moments that just went, you know what? This really is going to work. I still had some reservations, but it was one of my aha moments, like, okay, we're on the right track.
Yeah, Zesterman's an interesting person. I mean, what is he, an oboe player or something like that? I mean, it's like the farthest thing away from being a business person you could possibly be. He's a musician.
Yeah,
and,
right.
So when he gets up there and he's very, kind and gentle and loving kind of guy and says, hey, I did it, then, it strikes a lot of people that, wow, maybe I can do it too then. John, what about you? What was your aha moment?
I think really, Dave, he just makes so much sense, and he's going over the numbers, and you're going, yes, this just makes perfect sense. And then I think with Kathy, when you see the vast majority of the audience, and they're already in real estate, but it occurred to me that you're sitting in a room full of millionaires, first of all, and they're still coming to you and Dave Fisher because they want to do it correctly. That was my aha moment. I go, wait a second, and I had talked to some other people in the 2-day who weren't members, and they were like, oh yeah, I already have 10 properties, and they would always say, but I'm doing it incorrectly. I'm doing it wrong. And I think that was the aha moment for me of, okay, this is the right place to be. When you have people who are in the business already, and they have the courage to say, I'm doing it incorrectly. I'm not doing it the best that I can do it. I'm not optimizing it. And they're coming to you to learn, and they already have experience. So I think to me that was an aha moment right there. When you have the pros coming to Dell and Dave Fisher, there's something to be said about that.
Let's talk now about, and we've only got about 30 seconds to get through this. You said you went home and you looked under the cushion of the couch and found a few quarters and some other places. Where'd you find that your capital was hiding that you didn't realize you had it? She said the house. What else? Anything else?
Just some IRA retirement accounts, and that's how sad. I think I can sum it up. We didn't even know how to calculate our net worth before we joined. So that kind of tells you something right there that we weren't really financially ready, and we weren't financially savvy to even calculate our accurate net worth. But it was in IRA accounts. It was in just 401ks that we had forgotten about, just money that we just weren't tracking and weren't being responsible for.
We were going to take a short break, guys, and then we'll come back and jump on this again. For the rest of you out there, this is John and Kathy Garcia out of San Antonio, Texas.
Now, from the files of Del Walmsley.
Words have meaning. And if you can't understand people's words or inflections, then you can't understand them. If you're out there and you don't understand words that successful people use, you can't be successful without being able to articulate successful words. So I've got emails here where people ask me, can I really do this or not? And the answer is yes, but you got to get involved. You've got to be speaking to people about things you've never spoken to anyone about in the past. Otherwise, you won't understand the words. And if you don't understand the words, then you won't understand the sentences, and the sentences won't make sense in the paragraphs, and the paragraphs will not lead you to the solutions you need to change your life. We'll be right back with the Del Walmsley Radio Show.
Welcome back. Now here's some more unconventional wisdom to set you free from the man on a mission to retire America, one person at a time, Del Walmsley.
Welcome back to the Del Walmsley Radio Show. With me here today on Tell Del Tuesday is John and Kathy Garcia out of San Antonio, Texas. We were just talking about how they had come to the 2-day and found out that they really weren't financially organized enough to get ready to start making some major moves. So they went home, they looked at their resources and juggled them around a little bit and came back ready to take action. What was your first approach when you guys came back?
We joined, so we decided to join in February. So our first 2-day was in December of 16. It took us 2 months to figure things out, to, shuffle, move the couches around a bit, and literally. And we joined in a challenge program with Lifestyle. So we started out buying single-family property. And we had our first property within 2 months. And within 6 months, we had our first 3 properties up and running.
Let's talk about the first property. What kind of money did you have in that property? What kind of profit did you make off that deal?
That one, I think it wasn't so much of an equity capture. I think we wanted to get some cash flow. You want that immediate gratification, right? You're going to put down your down payment and you want to get that rent money. And I needed that for some reason. I don't know why. And maybe Kathy might have thought differently, but that one was cash flowing, I think, close to $500. That blew my mind. I'd never had an investment or an asset that paid me money basically, right after we closed. And it literally took about 5 minutes to rent that house. And it was, 1 month later, here we are getting some money. And then I think when we sold that one, I don't remember the exact, Kathy, do you remember the exact amount on that one?
So we earned the cash flow. We made the money 5 different ways. And when we walked away, we made about $40,000 on that house.
Yeah.
How much did you have invested in it? What did you have to put into that deal to get it done?
I think the time was a little less than $20,000, about $19,000.
Okay.
Yeah.
So you had easily a 200% return on that deal.
Yeah.
Was there any rehab on that deal? Did you have to do any rehab, or did you buy it as is?
We bought that one turnkey. Our mentor at the time, we worked with Joe and Jody and Jillian, and they were like, just get yourself a turnkey first. You want to dip your toe in the water, and you want to get some money. So they kind of held us back a little bit, and so that was turnkey. Very little work. I mean, you just basically make ready, and it was ready to go. That was really helpful, I think. It was a really great starting point for us, not having to go ahead and take on a large rehab.
I want to take you back to a statement you made here just a second ago and reiterate something. I remember when I bought my first rent houses. I bought one, bought 3 more, so I had 4, had $880 a month coming in. And I remember that feeling that you just espoused just a second ago about cash coming to you. And I started thinking about, okay, so I make $70,000 a year. I go to work and I sell memberships to a health club and bring in $100,000 a week, and they, we send that money into the bank and they're making $100,000 a week, and then that's $500,000 a month. At the end of the month, I get a paycheck that's 1/10 of 70, which is about 6, but by the time I get it, it's $3,500, and I'm thinking to myself, I sell one membership, it's $3,500, and I end up with $3,500. And when all of a sudden I was getting, like you said, $800 a month coming in, $880 actually, and there was no taxes being taken out, there was no insurance being taken out, there was no 401 or no IRA or no Medicare or Social Security being taken out, it blew my mind. It literally blew my mind that there was $800 more, about a third of what I was taking home, right? That feeling you were talking about, that is a real strange feeling, isn't it?
When you come from the 401k world, you put this money away and you can't touch it. You can never really touch it. I mean, you can look at it. You just kind of covet your own money, which is strange. And for us to go we took our $20,000 or $19,000, we bought a house with it, and then exactly 30 days later, I get $500 cash in the mail. And to me, that was just, I never had an investment like that. You can look at stocks and you can look at 401k, but it was addictive. You go, okay, I need to do another one. I want to do another one and another one, and keep going. And
it is very addictive. And the thing is, think about it. With a 401k, you put your $20,000 in there, or your 40, 50, or 80, whatever you put in there, and it doesn't pay you anything. In fact, every month you keep feeding the monster. You have to pay it. So it's right. Actually double negative, right? Now you got something right. For the first time ever that's paying you. It's not even, the normal person can't even conceive it. That's all I can say. And it's such a big point that you made. I had to, piggyback on it and remake it again because it is just such a big point. Kathy, how about you? What did you think when you first got into this?
I thought, okay, this is actually happening. We're doing this. I actually walked the property before John did and went, okay, I think we should do this. And we did it. We had very little anything. It was basically turnkey, put it on the market, and within a week we had a renter. So that was, it's back to what John said a minute ago. It's where you're getting that initial satisfaction. It's coming. It's like, oh, this is really going to work. And it became addicting. So like the number two, our strategy was we bought a house, we rented it, we waited a month, we bought a house. So we bought this one in April. It was rented immediately. So we took May off. We started looking again. We bought a house in June. Same thing, another turnkey property. Got somebody in it, bought another house in August. You start seeing that it's working. So I always knew, you trust your spouse. I trust my spouse. I just wasn't 100%. Yes, of course I trust you. I wasn't, I just wasn't 100% sold. And as soon as this started happening, I'm like, this is a real thing. This is really happening. And one thing that John didn't mention was he had just 2 years before taken a job that was a pay cut from his previous employer. So that extra cash flow was amazing for us because that brought us back up again. We're starting to get back up to where we were at the time. So that was another piece of the puzzle that we had coming in. So I was sold. I saw one of the mentors. I'm like, this is completely addicting. And they said, of course it is. That's just how it works. When you do it right and you learn how to do it right, you're never going to fail. You're going to succeed.
But Dale, I need to point out after the first house, Kathy was a little hesitant. I think when we first going into this, she's at the 2 days she's kind of holding us back and everything. Or hey, we don't think about this. After the first deal, Kathy was. She started hitting it hard. She's looking on MLS. She's calling up agents. She's just looking online.
All right, John, we're going to have to take a break.
It's not just the money. It's the lifestyle. Here's Del Walmsley.
The first day I went to Dallas, my gosh, there was 350 people in my first seminar there. It blew my mind. Then I realized there is pent-up desire for our product everywhere, for people that need help. They need to figure out how to retire. They need to figure out how to supplement their income. They need passive income, and they need motivational direction. And so Dallas took off. It just blew up, and all of a sudden we were like double the size in no time at all. And then after that, we had people complaining that we needed something down in San Antonio and Austin, so we opened up in San Antonio. Then we had people complaining it was too far to drive from Austin to go to San Antonio, so we opened up in Austin. We have people that started accumulating out on the West Coast, and Phoenix seemed to be a great place to buy, so everybody was buying in Phoenix, so we opened up in Phoenix. And then people accumulated on the East Coast, and Atlanta's kind of the central hub for the East Coast. So we have offices in all of these different places now. You just have to ask yourself, how did that happen? Now, that's just the office. The members, there's members in every state, 50 states in union, internationally also. We'll be right back with John and Kathy Garcia and the Del Walmsley Radio Show.
Welcome back. Now here's some more unconventional wisdom to set you free from the man on a mission to retire America, one person at a time, Del Walmsley.
Welcome back to Del Walmsley Radio Show. With me here on Tell Del Tuesday is John and Kathy Garcia out of San Antonio, Texas. As we went to break, John was telling us a story about how excited Kathy got after we started doing these deals and seeing the results. You want to pick that up, John?
Right after the first deal, Kathy became a monster. She just started looking online, and she's calling up agents and networking, and she found our second property. Went out there with one of the agents, and the agent called back and said, "Hey, this is a good property you found. You need to buy it." And so we said, okay. I didn't think she found a good property. I'm going to be honest. And I was like, you know what? I don't think she found a good property here. I'm going to make an excuse and stay at home. And then the agent called and said, nope, she found a gold mine here. You need to buy it. And went ahead and bought it. And that property was, again, cash flowing $500. I think that was another turnkey. Didn't take a lot of effort at all. It was just a make ready. I think we sold that one. I don't remember the details on that one, Kath, but it was cash flowing. We put down $15,000. It was cash flowing $500, and when we sold, I think we walked away with, I want to say, close to $50,000.
Probably.
Yeah. So again, Kathy, you did a great job on that one. Got to give her kudos for that one.
So that one's like 300% return.
That's why it gets more addictive, right? Yeah.
And Kathy, he didn't even have faith that you picked a good one, but you got a great one.
Well, I trust him, but clearly it's not the other way around.
I have been apologizing for many years now. I do listen to her now, big time.
So what do we do for the third one, guys?
Our mentors gave us a little push and said, you know what, why don't you guys try a rehab? Nothing major, just try one that needs to have some rehab. So obviously that means we're buying one that has equity in it. Bought it. It was one of the ones on the block that was just one of the worst ones on the block, but needed maybe $25,000 worth of work. Mm-hmm. This is the one that had the roach smashed up against the wall and painted over before we even walked in the door. They had a roach infestation. So we took care of all that. We took the cabinets out. We cleaned that house up beautifully and, again, got it rented. And the people there loved it. They stayed for 2 years. Then I got the next person in there, and it was an amazing house. Cash flow not at $500 that time, a little less than that. Turnaround, and after a couple years, sold that property. Made $36,000 on that property. Bought it for like $80 or $81. When you buy them that inexpensively, now you've got the equity, which moves you forward again, and it just becomes addicting. And then it was like, okay, I don't want any more turnkeys. I want ones that. Or, ones that are ready to go. I want the ones that we're going to have equity in, and that's what we have now. One thing that I want to say to people out there is do not hang on to them. Do not be afraid to sell them. We are not anybody. We literally listen to what our mentors told us and what our teachers have told us, and we hold them for literally 3 years. Because that's the time. It's time to move on. It's time to do other things. Time to go get 1 or 2 more houses out of selling one house, maybe 3, depending on how well the market has gone up.
So let's talk about that, because you're making a statement that the average person listening right now probably can't relate to. When you make the statement, it's time to sell them. What is making it the time to sell them? Can you be a little clearer on that?
Well, I think our perspective was things start to break, right? You've gone and you've done a complete rehab. You put in a water heater. You put in a new AC. Warranties start to expire. And I think the theory behind it is, all right, I want us to go ahead and start to let these properties go. I've already made my cash flow on them. I have a huge equity capture. It's just time to move on. And the real reason, too, is you want to double up, right? You want to go ahead and sell one. You take that 50 or 60K, you just pull out of it, and you're going to go buy 2 more. And so, the idea is I've had it long enough. I've made enough money to go and double up. I can buy 2 houses now. And I think that's the theory. At least that's been my perspective on that.
Yeah, I wanted you to get out the point. I wanted you to get the point out, which you did, that there's too much equity in the house. The rate of return actually starts to drop on a house as you build the equity. If you look at it internally and say, okay, I had $10,000 in this house and I'm making $500 a month. That's great, but now the house has $30,000 in equity. Well, that's 3 times more money in this deal, still only making $500 a month. You've lowered your rate of return by 30%, 60%, whatever it is.
Yep. Yes.
So there is a point where you do need to either re-leverage, go pull money out of it, remodel it again, like you say, things wear out, And that's literally what we do in apartment complexes. About every 5 years, we'll pull out money, put it back in our pocket, leave some of it in there, and remodel it again. So we get another good 5 years out of it. So that's a good point to make. So you got 3. You sold the third one also. Let's talk about the fourth one. What did you do at number 4?
I'm trying to think which was number 4, Kathy.
Number 4 is Palfrey.
Palfrey. Oh, that was a again, mentors are saying, okay, you've done a small rehab. It's time for you to do a major rehab now. And we said, okay, let's go, let's do it. And this one was it was on the south side of San Antonio. It's a 3-1, has a little 1-1 in the back, and we were able to renovate the whole thing. Well, I think we bought it for $65,000, and I think we sunk in maybe $35,000 on that rehab. And a little nervous. You know, you're nervous because this is a lot more work than we have ever done. And so, I mean, I didn't lose sleep, but I was definitely aware that this was a lot more work. I was going there to check on the contractors every few days. Kathy was doing drive-bys because, again, you know, this is still brand new to us. I think we're still kind of rookies on this. And it went smoothly. You know, the rehab was fine. We ended up renting that for, I think, $1,500. I think that was cash flowing. Kathy, was that $500 again?
No, it was probably like $450.
$450. Okay.
Much.
Did you rent the 1-1 out separately from the 3-1?
No.
So I was going to. I was going to rent it out, and it wasn't zoned properly. Apparently, I can rent a family member. And so the young man who moved in says, hey, I think my mom's going to move in here. I said, well, okay, when she does, you know, I'll get the lease with her. And she had a medical issue. They turned out to be really amazing residents, so we just kind of rented that one out for $1,500. That was above market anyway, by about $200. And so I was pretty happy. We could have rented out that 1-1, and, you know, of course, people are probably yelling at the radio right now, you should have rented it out. But at the time, it didn't really fit the equation with that resident. So I didn't rent that one. That's my fault.
So let's take a look at these last two, number 3 and number 4, that were rehabs. The listening audience needs to hear this. I'm assuming you didn't, you know, you said you spent $35,000 in rehab. I'm assuming you didn't spend the $35,000, that you rolled that into a hard money loan. Am I correct? Or?
Yes, sir. That's correct.
Explain to people how you did that.
So we found a house. They were asking $65,000 for it. We had to put in about $35,000 into it. It appraised, I think, at, Kathy, you can correct me if I'm wrong, but what, $135,000 or $140,000?
Exactly.
And so we ended up, and Kathy's much better at what we put down on each one than I am. So jump in anytime, Kathy.
Well, I don't know that that's really the question. I think the question is, yes, we contracted. We did not have to come up with that money out of pocket.
No.
We contacted what are called hard money lenders. So, yes, they, quote unquote, loaned us the money to do it. We didn't have to come up with all that out of our pocket. And the other thing I want to make a point about, too, is for people who hear, like, we rehabbed a house, we physically didn't do anything. We call it stimulating the economy. We hired contractors to go out. So we didn't do anything on any of these properties. We made sure that they were there. We made sure they were doing what was on the scope of work. And we were handing them checks, but we were not doing the work. We were not doing any of the work. We didn't do any of that. So I don't want people to think that we were out there with a hammer and nails doing that. We were not. We took our kids out there. We homeschool our kids, so our kids got to see a little bit of a different education, but they got to see what we were doing.
Right.
So I hope that answers the hard money question. Yes, we used hard money to do these properties.
Definitely. Okay. But I would never take my own money to a deal like that.
When I come back, what I'm going to want to explain is, if I've got these numbers right, you bought it for $65,000, you put in $35,000 in renovation dollars, so you're all in for about $100,000. You said it was worth something around $140,000. So after we come back from break, what we're going to want to find out is, how much did you guys actually come out of pocket to buy this thing?
Now, from the files of Del Walmsley.
I do want to make this point to everybody out there. All right. This poor lady signed up for one of these stupid stock trading courses. Do you understand that trading stocks on a daily basis like this is really nothing but gambling? You might as well sign up for how to cut cards or how to play cards, because it's just insane. You're going to lose. The odds are against you. It isn't going to work. And you know what? I want to add this to it. And so is every other real estate course out there that has to do with flipping and wholesaling and working your butt off and busting your butt and taking advantage of people and selling stuff too high and buying it too low and ripping people off. Guys, we're not doing any of that. We're buying assets that make us passive streams of income. We'll be right back with John and Kathy Garcia and the Del Walmsley Radio Show.
Welcome back. Now here's some more unconventional wisdom to set you free from the man on a mission to retire America, one person at a time, Del Walmsley.
Welcome back to Del Walmsley Radio Show. With me here today on Tell Del Tuesday is John and Kathy Garcia out of San Antonio, Texas. And guys, before we went to break, we talked about a deal you bought that cost you $65,000 to buy the house. You put in $35,000 with the renovations, and so you're all in for $100,000. But you said you had a preliminary appraisal or a table appraisal for $140,000. How did that shake out when you went to finance that? What did the hard money lender lend you, and what did you have to come up with?
I think we ended up coming with less than 20. It was maybe $15,000 or $16,000. It was not a lot. I mean, it again, another easy deal in that regard. Kathy, do you have any more numbers on that one?
I would say 16. I think we paid 16 out of pocket for that one. Again, very easy, very simple. Fast forwarding to today, that property is now worth $200,000.
We're liquidating right now, so I do have a firm appraisal on that one, and that one appraised at $205 as of today.
And originally you had sunk into it $100,000, but now you brought $16,000 to the closing table. Where did that money come out of? I'm trying to. If you've got 140 appraisal, and they'll lend you. What did they lend you? 70% of that? 80% of that? What did they lend?
I think that was 70%, Kathy, or 75.
Yeah, 75.
Of the 140.
Now you're asking homeschoolers about dollars.
We'll leave that for another day. The bottom line is you put in less money on the one you had to do $35,000 in rehab than you did on the one you put nothing in rehab in. That's the point.
Correct.
Yes, yeah, that's a good point, yeah. Exactly.
So you're going to sell that one now and make $100,000. And I'm just jotting this down here. We got $40,000 on the first one, $50,000 second one, $36,000. It's $136,000. You make another $100,000. That's a $236,000. That's $250,000 just in the first 4 deals, guys. Not to mention the cash flow.
Yes, right. Yeah, that's why it's addictive. It's like, I mean, yeah. And Del, to be honest, when we first started, I mean, our net worth. It's obviously we're talking about 3 deals here, but our net worth was dismal. I mean, it was laughable, and everybody had they had every right to make fun of it because it was just a horrible thing. And to be honest, to sit there and just do a few deals and to get that, as you said, $250,000, that just it makes you feel so much better. You can take care of your family. The money's there. I mean, all of a sudden we're cash heavy, and it feels great. You feel wonderful about that.
You currently have 6 houses, right?
Yes.
Sold these 4, or is number 4 is one of the 6 you own right now?
Yes.
So you bought 9 of them, is what you've done so far?
Correct.
What have these 9 houses meant for you? Let's start with what kind of total cash flow are you guys looking at a month?
We're looking at it's $1,892.
Pretty good. Pretty good cash flow. What does that mean to the family, guys? How's this changed your life?
Let me just take one real quick. We had a couple of health issues come up. We've had life kind of jump at us a lot for the past couple of years. We haven't had to worry about pretty much anything. We have the cash flow coming in. We know that we're going to be okay. John was able to quit a job he absolutely hated and take 2 months off and find the one that he really wanted, and that's what's happening. Not that this covers every one of our bills, but this covers our major bills. We haven't had to think twice about stuff. We've taken the sold from their properties, we turn them into other, what I'm trying to say is we built up a little nest egg of cash flow. And so we have been able to keep going with what our daily lives are. We homeschool our kids. Our kids get to do extracurriculars. We've been able to travel a little bit more. It's changed our life completely. John, you want to add to that?
We're more secure than we were 5, 6, 7 years ago. If I had quit my job, I would be, hitting the pounding the pavement the very next day, throwing out resumes. I quit this job on a whim and just took some time off and just I've been lazy.
We didn't blink an eye. We didn't blink an eye.
Nothing changed. Nothing was canceled. We didn't, start turning phones off or, turning the AC off. None of that happened. And it was because of what we've learned with lifestyles and everything that we've accomplished, just to have that little bit of that financial freedom. And, most people can't go and quit a job right now and go without a paycheck for, 2, 3, 4 months. We could have easily done that, just drastically changed our life. It's made it more secure.
Yeah.
So what's the future look like? You got 1 minute left. Tell us what you're going to do.
Well, we're liquidating everything right now, getting ready for our first multifamily deal.
So, jump up and play in the big boys.
Yes, sir. That's about time. It's when you're all in the room, I'm the small potatoes in there, and I'm like, you know what? I want to join that group. I want to be with those guys. So, that's the plan.
Are you going to do an IRO deal, or are you going to do a lead deal?
We want to do a lead deal.
Okay.
We definitely want to do a lead deal.
Well, that should be exciting. Any idea what size you're looking for your first deal?
We actually just put an offer in today. It's a 13-unit down in Aransas Pass. And we're working with the lifestyles agent. We're working with the mentors right now. So everything is moving pretty smoothly right now. It's a lot faster than I thought, but I'm getting used to it now. So Kath and I we're loving this. And it's such a different environment, it's a different world. It's a whole different perspective. And like you said, it's the big boys. And it can be intimidating. But, you've got to take that leap. You've got to move into that. For me, I want to move into that environment. So does Captain.
Guys, I want to thank you both for coming on today.
Now, from the files of Del Walmsley.
We're in a situation right now where people are buying assets, big assets, large apartment complexes, expensive homes, massive amounts of real estate as a hedge. And what are they hedging? They're hedging inflation, because real estate is a inflation hedged asset. It goes up when everything else goes up. Now, the reason why real estate is so good as a hedge is because, unlike gold, which may go up and down with the value as inflation occurs, it doesn't put off any income. And so real estate is producing income. It's producing rental income for the people that are doing it the right way. So whether or not my asset goes up or whether it doesn't, I'm hedged because I'm going to get income either way. Now, if there's massive inflation, then my asset keeps up with inflation. I want everybody out there to remember this. John, Kathy, myself, everyone here, we're not doing this for a little money. We're doing it for a lifestyle. Have a wonderful day. We'll see you tomorrow.
The information and opinions you hear on the Del Walmsley radio show are those of the host, Del Walmsley, his guests, and his callers, and do not necessarily reflect the opinions of this station, its affiliates, its management, or advertisers. The Del Walmsley show is for entertainment purposes only. Please consult a professional regarding your personal investment needs. Nothing presented on the Del Walmsley show constitutes an endorsement, recommendation, offer, or solicitation to buy or sell any product or security.